When you see a stock surge, like 340% in a single year, do you see a massive generational opportunity, or are you looking at a perfectly baited trap?
Oh man, it is the ultimate Rorschach test for market sentiment right now.
Right.
Yeah. You look at that vertical climb and you either see this infrastructure super cycle that you just feel like you have to buy into at any cost, or you see an absolute cliff edge that is just waiting for retail investors to take the fall.
I mean, it's terrifying and exciting all at once.
Yeah.
Welcome to a deep dive into the source material on Corning Inc., trading under the ticker symbol GLW.
Yep, GLW.
Today is April 13th, 2026, and we have compiled a massive stack of fresh financial data, market sentiment reports, technical charts, and institutional order flows.
You've got it all.
We really do. Our mission today is to just cut through all the noise and figure out whether Corning's aggressive bullish surge is actually supported by its fundamental business, or if we're basically watching an AI hype bubble stretched to its absolute breaking point.
This is a very real possibility.
Exactly.
Yeah.
But before we get into the weeds, a quick reminder to please like the video, subscribe to our YouTube channel, and this is compulsory. Leave your feedback in the comments below.
We need to know what you guys think.
We really do. And as always, just setting the ground rules here, this is a natural human debate exploring the data. Absolutely none of this is financial advice.
Definitely not.
So to really understand the stakes here, we have to first contextualize the sheer violence of this price action, right?
Yeah, violence is the perfect word for it. Just 3 days ago, on April 10th, Corning closed at $171.24.
Which is wild.
It is. For a legacy materials manufacturer, that price level is completely unmoored from its historical baseline. I mean, they're sitting just 3% below an all-time high of $176.75.
And we aren't talking about, a steady multi-year climb here.
No, not at all.
This stock was languishing at a 52-week low of $38.56.
Just think about that gap.
Right. A 340% explosion from that floor fundamentally changes the entire profile of the company in the eyes of Wall Street.
Yeah.
You don't get a 340% jump because you had like a slightly better than expected quarter selling Gorilla Glass for smartphones.
No, absolutely not.
A move of that magnitude requires a structural tectonic shift in how the market views the company's future cash flows.
And the catalyst driving that shift is entirely tied to the physical realities of artificial intelligence.
Right, the infrastructure.
Exactly. Our sources point directly to a massive bottleneck in AI development, which is optical networking. Generative AI isn't just, lines of code floating in the cloud. It requires a colossal physical footprint.
Oh, massive.
Yeah, when you are training the next iteration of a massive language model, you have tens of thousands of processing units that all need to synchronize data instantaneously.
And if you try to push that much data through traditional copper wiring at those speeds,
You literally melt the server rack.
right, the heat generation and the bandwidth limitations make legacy architecture completely obsolete for AI.
Which leaves only one viable physical medium for data transfer at that scale: light.
Fiber optics.
Exactly. And Corning is the foundational bedrock of advanced glass and fiber optics globally. So the headline...
But here's the friction point I really want to push back on. The stock is already at $171. Institutional buyers have sophisticated entry and exit algorithms. By the time retail investors read the headline about a $6 billion meta deal and hit the buy button, aren't we already late to the launch party?
Oh, that's the big question.
I mean, hasn't the easy money from $38 to $100 already been extracted? It feels like FOMO, the fear of missing out, is totally taking the wheel here.
Well, that skepticism is exactly how you survive in a market trading at all-time highs. When smart money floods in early, it validates the macro trend, sure.
Right.
But at 171, you are paying a massive premium for future execution. To strip away that FOMO and figure out if the underlying engine can actually sustain this altitude, we have to look directly at the fiscal year 2025 financials.
Okay, let's pull apart that income statement then. Fiscal year 2025 delivered record-breaking top-line growth.
It was a huge...
Total revenue hit $15.63 billion,
Yeah.
which is an incredibly robust 19.14% year-over-year increase.
Great numbers.
Really great. But the top line isn't what triggered a 340% stock surge. It's the bottom line. Net income skyrocketed by 215.4%.
215%.
Yeah, taking it to $1.60 billion.
Mm.
Operating income clocked in at $2.32 billion. And their trailing 12 months earnings per share is sitting at 1.83 to 1.84.
Okay, we really need to stop and look at the mathematical relationship between those two figures.
The revenue and the net income.
Yes. Revenue grew by 19%, but net income grew by 215%. That massive divergence tells a crucial story about operational leverage.
Explain that for the listener. How does that leverage actually work in this industry?
So in advanced glass manufacturing, the barrier to entry is astronomical. You have to build billion-dollar fabrication plants and run massive furnaces continuously. The fixed costs are just massive.
Like they can't ever turn the furnaces off, right?
Exactly. But once those fixed costs are covered by your baseline revenue, every additional spool of fiber optic cable you sell carries an incredibly high profit margin. So that 19% bump in top-line revenue from new AI demand, it cascaded almost entirely straight down to the bottom line.
Which completely explains the operating cash flow surging to $2.70 billion.
Yep.
And from that, they generated $1.41 billion in free cash flow.
Yep.
But, and this is key from our sources, they aren't just hoarding that cash. They recorded a $1.28 billion capital expenditure outflow.
That's the CapEx.
Right. They are aggressively pouring cash back into the ground, likely expanding fabrication capacity to actually deliver on that $6 billion meta deal.
Because you have to build the factories before you can ship the product. That CapEx outflow is a necessary reality of securing multi-billion-dollar, multi-year enterprise contracts.
It takes money to make money.
Exactly. But looking at the broader balance sheet, this is where we start to see some structural cracks in the whole bull thesis.
Uh-oh.
Yeah. They are sitting on total assets of $30.98 billion against liabilities of $18.67 billion, which leaves a healthy total equity of $12.31 billion.
It's solid on the surface.
It does. But equity doesn't pay the bills if liquidity dries up. Let's look at the cash position. They have $1.53 billion in cash on hand.
Which sounds comfortable.
It sounds comfortable until you look at the debt load. They are dragging a massive $6.91 billion net debt anchor.
Wait, nearly $7 billion in net debt?
Almost $7 billion, yeah.
In an economic environment where interest rates are a constant headwind, how fragile does that make this 215% growth narrative? I mean, with that kind of debt, how risky is this?
It introduces a severe vulnerability. That debt load is the primary reason this stock is a battleground rather than just a universal consensus buy.
Right, because servicing debt isn't cheap.
Exactly. Servicing nearly $7 billion in debt eats directly into that $1.41 billion in free cash flow. If Meta or, any other major enterprise client suddenly decides to delay a deployment schedule by 6 months.
Just to optimize their own servers or whatever.
Right. Corning still has to service that debt. The interest payments do not pause just because the supply chain got snarled.
So we have this spectacular operational leverage driven by a genuine AI infrastructure supercycle. But it's chained to a massive debt load.
That's the tension.
And that tension forces us to look at how the market is physically trading the stock right now. We need to dissect the technical analysis.
Oh, the technicals. The indicators paint a picture in a market completely detached from its historical baseline.
Totally.
The momentum is historically aggressive. If you look at the moving averages, the 50-day simple moving average is currently trailing way down at $135.65.
Way down.
And the 200-day simple moving average is sitting all the way down at $91.75.
Just visualize that gap for a second. The stock is trading at 171. The 200-day average price, which is the long-term consensus of what this company is worth, is roughly $80 below the current trading price.
It's massive.
That is not a sustainable organic climb. That is a vertical price shock.
And it sets up some very precarious technical levels. The immediate ceiling, the resistance level the stock is struggling to break, is that all-time high of 176.75. If the momentum breaks and the stock begins to slide, the immediate support level traders are watching is $165.9.
Okay.
But if that floor collapses, the next technical safety net is way down at 147.92.
But I mean, those support levels are only psychological, right? They don't actually arrest a fall if the big institutions decide to exit.
Not at all.
Which brings us to arguably the most glaring red flag in our source data, the momentum warning, the RSI.
The relative strength index.
Right. It's currently pinned at 76.49. Break down what that RSI of 76 actually means for someone watching the charts.
Yeah, so for context, an RSI above 70 is a severe overbought signal. An RSI of 76 is like stretching a heavy industrial rubber band to its absolute physical limit.
Oh, wow.
The sheer intensity and duration of the buying pressure has mathematically stretched the stock price completely out of equilibrium.
So it's basically a sprinter who's been running at top speed for miles. They look amazing, but they have to catch their breath eventually.
Yeah.
Is that 176.75 resistance line where they finally trip?
It very well could be. It doesn't guarantee the rubber band breaks today, but every single day it stays stretched at 76. It exponentially increases the violence of the snapback when the buying pressure finally exhausts itself.
And a stock this overbought becomes incredibly fragile.
Very.
Even objectively good news can trigger a violent sell-off because large funds will use the positive headline liquidity to dump their shares, lock in their 300% profit, and just move to the sidelines.
Which is standard practice for them.
Exactly. Which makes the current Wall Street consensus look completely baffling. According to our data, analyst sentiment is overwhelmingly rating Corning as a buy or a strong buy.
The analyst price targets are particularly revealing regarding how Wall Street operates during a momentum surge.
How so?
While Mizuho recently upgraded their price target to 160, UBS upgraded theirs to 171.
But wait, the stock closed at 171.24. The analysts aren't predicting future value, they're just desperately adjusting their models to chase the current price action. If UBS says the target is a 171, and we were already past that, they are implicitly admitting there is no near-term upside left in their own valuation models.
Bingo. And this brings us to the ultimate valuation reality check. Corning is currently trading at a price-to-earnings ratio of 93.45.
Wait, a PE over 90?
Almost 94, yeah.
You're paying $93 for every $1 of current earnings.
Yeah.
For a legacy industrial manufacturing company burdened with nearly $7 billion in debt.
It's staggering.
That valuation is priced to absolute mathematical perfection. It leaves zero room for error. It assumes that nothing goes wrong in the supply chain, interest rates don't squeeze their debt servicing, and Meta doesn't negotiate tighter margins on future orders.
Right.
How are analysts calling this a buy when it feels like a classic trap where retail traders end up holding the bag? How do they justify a 93 multiple?
Well, the justification hinges entirely on forward earnings estimates. The bullish argument is that Corning will deliver 17% plus EPS growth next year. The theory is that if earnings grow fast enough, that 93 multiple will rapidly compress. The company essentially, quote-unquote, grows into its massive valuation over the next few quarters.
But wait, even if they hit 17% earnings growth perfectly, paying a 93 PE for 17% growth is an astronomical premium.
Oh, it's huge.
Traditional value investing looks for parity between the multiple and the growth rate. You are paying a massive premium for a growth rate that leaves zero margin for error. If they miss that 17% target by even 0.5%, well, a stock trading at 93 times earnings doesn't just dip, it violently corrects.
Yep.
This looks like a textbook trap.
But it's crucial to differentiate the types of traps we see in the market.
Okay, what do you mean?
A traditional value trap is a stock that looks cheap on paper, right? Maybe trading at a 5 PE, but the underlying business is actively dying.
Right, circling the drain.
Corning is the exact inverse of that. This is a momentum trap. The business is fundamentally thriving, but the stock price has accelerated so far beyond the underlying fundamentals that buying at 171 exposes you to catastrophic downside risk, even if the company continues to execute well.
That sets the stage perfectly to lay out the distinct bull and bear cases forming in the data. We need to map out exactly what happens if things go right and what the carnage looks like if the floor falls out.
Let's start with the bull case. It's rooted in the physical reality of the macroeconomic landscape. The demand for generative AI data center infrastructure is a structural paradigm shift. It is not a cyclical trend.
Is the new reality.
Exactly. That $6 billion deal with Meta is proof of concept. It proves Corning can secure massive long-term enterprise deployments. If they successfully execute the Meta contract, they basically become the default optical networking provider for the entire AI revolution.
Because everyone else needs the exact same thing.
Right. Google, Amazon, Microsoft, they all face the exact same physical bandwidth limitations as Meta. If Corning becomes the indispensable backbone of global AI infrastructure, hitting that 17% EPS growth is just the beginning.
So in that scenario, the multi-year runway actually makes the 93 PE look justified in hindsight.
In that specific best-case scenario, yes.
But the bear case is looming right behind that optimism. The bear thesis triggers the exact moment reality fails to match that price-to-perfection valuation. With a 93 PE and a $6.91 billion net debt load, the worst-case scenario isn't a company collapse.
No, not at all.
It's a simple earnings disappointment. If management guides lower for the upcoming quarter, or if they mention a slight margin compression due to, raw material costs, the smart money will hit the exits instantly.
And we really have to analyze the specific market psychology, the order flow right now.
Break that down.
Okay, the large institutions, the ones who bought massive blocks of shares way down at $60, $80, and $100, they are currently sitting on 200 to 300% unrealized gains.
Just massive profits on paper.
On paper. But to realize those gains, they have to sell millions of shares. But you can't sell millions of shares into an empty market without crashing the price.
Right. You need buyers.
You need massive liquidity. You need thousands of eager buyers on the other side of that trade.
And who is buying right now? Retail investors driven by FOMO, reading about the meta deal and chasing the green candles on the chart.
Exactly. This phase of the market cycle is literally called distribution. The institutions quietly feed their shares to retail investors who are desperate to get in on the AI boom.
Wow.
The moment the retail buying volume begins to dry up, the institutions aggressively lock in their final gains. The buying pressure vanishes instantly, and the stock price plummets through those psychological support levels we discussed.
Leaving the retail investor who bought at 171 holding a violently depreciating asset. I mean, if the stock just reverts to its 50-day moving average of a 135.65, that is a devastating 20% portfolio loss on a company with record-breaking revenues. That is the true danger of a momentum trap. You can be entirely right about the company's fundamental success and still lose your shirt on the stock price.
Which forces us to map out the specific timeline of how this will likely unfold. We have a very clear bifurcation here between the short-term mechanics and the long-term fundamentals.
Let's talk short-term first.
Looking at the short-term outlook, meaning the next few days to weeks, consolidation is mathematically highly probable.
I mean, it has to be.
Yeah.
With the RSI stretched to 76 and the valuation hovering near a 94 multiple, the momentum simply cannot sustain a vertical trajectory indefinitely.
It defies physics.
Right. So traders analyzing this data should anticipate short-term weakness or sideways trading as the broader market kind of digests this massive 340% run.
And we know exactly when that short-term consolidation will be truly tested. The next major catalyst is the upcoming earnings report, firmly circled on the calendar for April 28, 2026.
April 28th.
That singular event will dictate the next major directional move.
And the stakes for that April 28th call are astronomical. Management has to deliver flawless execution.
Whoa.
They have to prove that the meta deal is already positively impacting operating margins. They have to show they are managing the $6.91 billion debt effectively. And their forward guidance for the rest of 2026 has to be aggressively bullish.
Anything less is a disaster.
Any hesitation, any minor downward revision will be punished ruthlessly by a market demanding perfection.
But if we zoom out from the April 28th earnings anxiety and look at the long-term macro outlook, the fundamentals remain fiercely bullish. You literally cannot build the data centers required to run generative AI models in 2030 without laying millions of miles of advanced optical fiber.
It's non-negotiable.
It is a physical limitation of data transfer. Corning has positioned itself at the absolute center of that physical bottleneck.
So navigating this data really comes down to deeply understanding your own time horizon. If you are stepping into this trade for the short game, you are walking a high wire.
Without a net.
Yeah, you are navigating severe imminent volatility, and RSI screaming for a pullback, and the ever-present threat of institutional distribution where you basically become the exit liquidity.
Conversely, if you are playing a multi-year long game, you're placing a structural bet on an AI infrastructure supercycle. A long-term investor might view a violent short-term pullback to 135 not as a panic event, but as a technical reset.
Right, a buying opportunity.
Because they're betting on the fundamental necessity of optical fiber in the computing landscape of the next decade.
It is entirely about knowing exactly what game you're playing before you deploy your capital. Let's pull all these threads together and summarize the landscape we've mapped out today.
Let's do it.
On one hand, we're looking at a fundamentally sound company that executed a brilliant operational pivot in 2025. They parlayed massive AI data center demand, highlighted by that $6 billion Meta contract, into a 215% surge in net income.
Incredible number.
They have incredible operational leverage, proving they can turn top-line revenue into pure profit at scale.
But looming over that fundamental success is a historically aggressive technical and valuation profile.
Right.
The stock is up 340% from its 52-week low. The RSI is flashing severe overbought signals at 76. They are carrying nearly $7 billion in net debt into a high-interest environment. And the market is pacing them at an unforgiving 93 times earnings.
It's a lot of pressure.
The risk of a sharp institutional profit-taking pullback is not just a theoretical possibility, it is a structural probability.
It really is a truly fascinating tension between underlying business strength and extreme market euphoria. And before we close out, a vital reminder. Our deep dive today was a pure exploration and analysis of the source material, financial data, and market mechanics.
Absolutely none of this is financial advice.
We are just exploring the data. We highly encourage you to like the video, subscribe to the channel, and most importantly, it is compulsory that you leave your feedback in the comments below.
Yeah.
We want your technical analysis. Do you see the $171 price as a sustainable new baseline? Or are you waiting for the trap to snap shut? Drop your predictions below.
And as you debate whether this is a generational entry point or a perfectly engineered momentum trap, I'll leave you with this one final thought to mull over.
Go for it.
If generative AI is the modern gold rush, everyone assumes the safest bet is selling the pickaxes. In this case, Corning's selling fiber optics to tech giants. But if those tech giants are funneling billions into CapEx just to build the initial infrastructure, what happens to the pickaxe sellers when the infrastructure is finally built and the tech giants decide they have enough data capacity for the next decade?